Silver investors, 2026 is not giving you a simple up or down answer. Right now, silver is acting like a live wire. One part hidden opportunity, one part potential bull trap, and anyone who treats it like a sleepy metal is going to get humbled very fast. I'm OG John AG, and in this video, we're going to break down why 2026 silver sits right in the crossfire between the Fed, the dollar, green energy demand, and leverage, and what that actually means for you as a trader or long-term stacker. By the end, you'll know exactly when silver is offering you a gift, and when it's just bait to pull you into a brutal shakeout. Segment 1. Vibe check. Silver is a battleground, not a sleepy chart. Let's start with the vibe, because before price, you need to understand the tape. Silver is in a tense, high-energy phase, tight ranges, emotional swings, clean rallies that suddenly reverse when one Fed comment or one data print hits the screen. Dip buyers are active, but the bears are still defending key zones with confidence. That's the first clue. This is not a quiet accumulation market. This is a battleground where both sides are funded, levered, and ready to hit the button. When you open the chart in 2026 and think, "Yar, ye kya zigzag hai?" That's exactly what's going on. Silver is being traded as a macro instrument, not as a random commodity. Segment 2, the story. Silver's double identity in 2026. To understand this year, you have to respect silver's double life. It's not just poor man's gold anymore. It's sitting at the intersection of two huge engines. Monetary chaos and inflation hedging, same bucket as gold. Industrial and green tech demand, a bucket gold is not really in. While everyone else is staring at gold headlines when recession fears spike, silver is quietly sitting where monetary policy and real-world demand collide. That's why the moves are sharper, nastier, and more emotional. If you ignore one side, only treat it like a currency hedge, or only treat it like an industrial metal, you will misread the whole 2026 setup. Segment 3, Fed versus inflation, the macro engine behind every big silver move. Now let's talk about the core driver, the Fed, rates, inflation expectations, and the dollar. The last few years, the Fed has been in a constant tug of war, kill inflation with higher rates, but don't nuke growth and risk assets at the same time. As the market leans toward gradual rate cuts instead of more aggressive hikes, real yields stop being so punishing, and suddenly hard assets like silver start to look interesting again. The logic is simple. Higher rates and rising real yields are a headwind. Cash and bonds look attractive. Silver gets sold. Lower or stable rates with sticky inflation are a tailwind. Suddenly, hard asset insurance makes more sense than sitting in slowly melting cash. Recent inflation data has been messy. Not runaway hyperinflation, but also not a clean, neat victory. Every hot CPI or PCE print breathes life into the hard asset trade. Every soft number gives bears an excuse to scream disinflation and slam the short button. Silver is sitting right there in the crossfire, which is why you see strong upside days followed by violent intraday reversals. Segment 4, dollar, risk appetite, and why silver behaves like a beta safe haven. The second macro pillar is the US dollar and global risk appetite. A strong, resilient dollar is usually a headwind for silver because the metal is priced in USD. Every tick up in the dollar makes silver more expensive for the rest of the world, but the narrative in 2026 is more nuanced. Big money isn't only watching the DXY, they're tracking real yields versus inflation, recession risk versus soft landing hopes, geopolitical risk, and safe haven demand. On chaotic days, wars, market stress, equity wobble, silver sometimes trades like a beta safe haven, more volatile than gold, but still a perceived store of value. That's why you'll see days where silver rips higher on fear, and days where it gets dumped as funds de-risk and close leveraged positions across the board. The key idea, silver is not pure risk on and not pure risk off. It's a hybrid, and hybrids move violently. Segment 5, industrial demand, solar, EVs, and the quiet bull story. Now let's zoom into the part most traders pretend to care about, but rarely quantify, industrial demand. Silver is not just shiny metal. It's an industrial workhorse with unmatched electrical conductivity. It's critical for solar photovoltaics, silver paste in PV cells, EVs and charging infrastructure, power electronics, 5G components, medical tech, high-end electronics, military and aerospace. Governments are doubling down on decarbonization. More solar, more EVs, more electrification. Engineers can try to thrift and use less silver per panel, but when the total installed base explodes, aggregate demand for silver stays substantial. Here's the line nobody sees on a daily chart. A big chunk of silver mined every year is getting locked into infrastructure and tech that won't come back to market anytime soon. That quiet, grinding drain is the structural bull case under all the noise. Segment 6, supply constraints. Why the faucet can't just be turned up. On the supply side, silver has its own weaknesses. Most silver production is a byproduct of other metals like lead, zinc, or copper, which means you can't just decide to double silver output because the silver price went up. Years of volatile prices have discouraged new aggressive investment in mines. Producers have spent long periods in survival mode, cost-cutting, delaying projects, being conservative. Layer on tighter environmental and social regulations, higher permitting friction, and suddenly the supply faucet for silver looks anything but flexible. If green tech and investor demand ramp together, supply may not respond fast enough, and that's how squeeze-like conditions build over time without any hashtag movement. That's your second big theme, slow-moving supply against fast-moving macro. Segment 7, gold-silver ratio, opportunity signal, not a timing tool. Let's talk about a ratio every silver bull loves to screenshot, the gold-silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. When this ratio is elevated, silver looks cheap relative to gold. When it's compressed, silver looks expensive. In recent years, this ratio has often lived at historically high levels, and long-term silver bulls treat that as a coiled spring. Their argument is simple. Gold has already repriced to the new monetary reality. Silver, with both monetary and industrial characteristics, has lagged and may have catch-up potential. But here's the discipline part. The ratio is context, not a trigger. It can stay stretched for a long time, and anyone using it as a signal to go all in on a random Tuesday is asking to be the liquidity for someone else. Smart players use it alongside price action, macro signals, and positioning, not as a standalone green light. Segment 8, sentiment. From Instagram stackers to TikTok, silver squeeze, hype now, sentiment. Silver's mood swings online tell you a lot about where we are in the emotional cycle. Right now, you can see a mixed combustible picture. YouTube has detailed technical breakdowns calling for breakouts if key resistance breaks. Instagram's silver stacking culture is alive. Monster boxes, coins, bars with captions about hard money and getting out of fiat. TikTok has short, punchy clips reviving the silver squeeze fantasy. Institutional players are way more clinical. They're watching futures positioning, ETF flows, and macro headlines. You see phases of quiet accumulation on dips, and then brutal liquidation waves when the narrative flips to risk-off. So where are we? Not dead, not mania. Silver is in that uncomfortable middle zone where both fear and greed are present. Perfect environment for big moves and big mistakes. Segment 9, whale activity, how big players leave footprints. Whales in silver show up in 3 main forms: hedge funds, large physical buyers, and ETFs. You won't see them bragging in comments. You'll see them in footprints. Clues include sudden shifts in futures, open interest alongside strong directional candles. Noticeable changes in holdings at major silver-backed ETFs, persistent buying or selling near key levels instead of one-day spikes. If price sells off but refuses to break obvious support and volume shows absorption, that's usually quiet accumulation. If rallies stall again and again at overhead resistance while open interest spikes, that's a crowded long, a setup for a flush if the story turns. This is where discipline separates traders from tourists. You respect where whales drew their lines in the sand. You don't fight them blindly. Segment 10. So, hidden opportunity or dangerous bull trap? Let's put it together. The macro backdrop has shifted from all-out inflation war to a messier environment. Moderated but sticky inflation, cautious rate cut talk, and constant geopolitical noise. Under that you have a monetary metal story that's still alive, a secular industrial demand engine from solar, EVs, tech, and infrastructure, a supply side that cannot instantly ramp to match every spike in demand. Structurally, that is an opportunity, especially for long-term stackers who care more about purchasing power than monthly candles. But silver's character hasn't changed. It overshoots both ways, punishes leverage, and can drag sideways for months before exploding. For traders, 2026 silver is absolutely a potential bull trap if you chase parabolic breakouts without a risk plan. For disciplined players, the same volatility is the hidden opportunity. If you size correctly, respect levels, and understand the macro drivers behind each big move. Segment 11, practical playbook for 2026, silver traders and stackers. So what do you actually do with all of this? For traders, respect the trend and key zones where bulls and bears have fought before, former highs, recent lows, major trend lines. Track macro, Fed tone, inflation prints, dollar direction, and risk sentiment matter more than your favorite intraday candle pattern. Manage risk like a professional. Position sizing and stops are not optional with a metal that loves overreaction. For long-term stackers, accept volatility as the price of admission. Wide drawdowns are accumulation windows, not personal insults. Focus on the big intersection, monetary risk, currency debasement, and relentless industrial demand. Build positions over time instead of all in at one price, so dips become opportunities instead of existential crises. So is silver 2026 a hidden opportunity or a dangerous bull trap? The honest answer, it can be either. The market isn't going to adjust to your time frame. You have to adjust your framework to the market. You've been watching John AG here, and I'm OG John AG. If this helped you see beyond the daily noise and understand the real engines behind silver's wild moves, hit like so this kind of content doesn't get buried. Smash subscribe and turn on all notifications. We're going deeper into COMEX games, green energy demand, and real positioning in upcoming episodes. And now tell me in the comments, silver 2026, opportunity or bull trap for you, and why? Because on this channel, we don't follow hype. We follow the math, the flows, and the framework.